Silver Dave here, and I'm coming to you before markets open today. And I've been working a lot on sort of the machine learning program, and I have a new version. I've jumped 3 versions forward, so we're now on version 7 of the machine learning program, and it is a few percentage points more accurate. So, and quite a few things have happened in the market while I was working on this. So let's find out what's been happening to gold, silver, and potentially what's going to happen maybe to the stock market. I found some interesting things with the machine learning program, so let's find out. Oh boy, it's been a wild ride. So I wasn't paying so much attention to the gold markets except what was coming out of the machine learning programs I was working on. And I didn't track like the daily prices day to day. And I remember like over New Year's, I kind of like posted a bit less. And I spent a little bit more time focusing on finishing up the machine learning program, the new improved version. And basically what I see is, gold moved up quite a bit. I remember like making a video saying that, when gold was at the 1700 levels, 1800 levels, that probably, looking at the RSI, it does look a bit oversold. And considering the macroeconomic environment with all the money printing, it's not a bad idea to buy a little bit of gold at that point. I said, don't go all in, cost average. And I did that for myself. I've shown you guys that I've been buying gold sovereigns like in a consistent manner on a week-to-week basis, more or less, during that period until the 1850. I think my last orders were around the $1830 mark. And I mean, gold has gone up since I buy them in Swiss francs, so it's a little bit different, but it has gone up too. I think for my gold sovereigns, I would be paying about $20 more, or a bit more, $25 more today if I bought the gold sovereign compared to when I bought it when I placed my orders. So that kind of like worked out well for me. But it can go up, it can go down, it could bottom out someday. If you look historically, there are places where it has bottomed out. Now, do I think that gold has a lot of things going for it? Like I tell always on my channel, you shouldn't go all in on everything. But there's a lot of things in the macroeconomic environment that suggests that gold is moving in a positive direction because one, because of the increase in monetary supply, two, because of the decrease in velocity for the US dollar. Also, the US dollar is continuously weakening against every single other currency. And in my playbook, gold is a currency hedge against currency risk. To a certain extent, silver can sort of be that, but silver's more expectations on inflation, which could be related to currency risk and currency devaluation. But it's sort of like a secondary measure, right? It happens afterwards. And I do believe that, silver is cheap. Silver was cheap. Silver is still relatively cheap. It did have a lot of gains. Silver moved up quite a bit since before. But, silver is volatile. Silver has always been more volatile than gold. And the ups are much higher, the downs are much lower. Now, I want to show you something else that I've been looking at is the stock market. And some interesting things have been happening in the stock market. If you go to not just my channel, but there's a lot of other channels doing technical analysis on the stock market. And what they're seeing is sort of, there is sort of this movement in the stock market where it seems to be like, there seems to be a squeeze at the top, and then potentially, we could get like a drop. And I think that's possible. It's, at this point, it's too early to say if there will be a crash or not. And in order to make that assessment, I did adapt the machine learning program. And I think if you've been following my channel, I had another version of this, the version 5, I think, of the S&P 500 predictor. I've been working on it to increase its accuracy, and it's become pretty damn accurate. And sort of the error margins are much lower, and it's much better at showing when there's a high degree of movement in the S&P 500 that should not be expected. And in this case, what I'm seeing here is there's a start. There is a start of a downward trend in the short term. That means that considering historical volatility of the S&P 500, at least in the short term, that means the weekly volatility of the S&P 500 over the last week, it doesn't tend to move so aggressively. And it's moving, the weekly movement is more aggressive than the monthly movement. And it's not within the range of the monthly movement anymore, at least on the 3-day charts and the 3-day analysis, the 3-day projection. And when I look at the 7-day, projection, of course, it's getting close. The two, I would say, volatility bands are getting close to each other. Does it mean that we're going to go for a crash? It's not a good sign. You never want basically your volatility signs on the S&P 500 to be so divergent. But normally you want to see these nice separations between the bands. When the bands get too close, it means that the short-term volatility is much higher than the historical volatility. And if the stock market's momentum is moving, downwards, then that is a pattern of a crash. Now, right now, if I look at the 7-day, there was this downward, and then there's a little bit of an upward. I don't know what the markets will open at today. If you look at the futures, maybe like it will open a little bit lower due to election expectations, or it could move higher because people expect more stimulus. But either way, I think if we do get more stimulus, or if people expect more taxes, more devaluation, slow down the economy, these are all things that move gold upwards. Because gold, remember, is a pure currency risk play, and it's currency risk on the dollar. And it's not like a pure currency; it's mainly a currency risk play. And I think most of the movement in gold, at least this year, is due to currency risk. And I'm seeing that sort of in the patterns of the predictive values, right? When I use the machine learning model, it looks at a lot of different indicators. And the indicator that it's saying, that contributes the most to the movement of gold is movement in currencies. And of course, treasury, stock markets, physical demand of lumber and soybeans, they all affect, of course, the price of gold, but to a lesser degree. They will affect the movement of gold, but to a lesser degree. The more prominent, I think, that's accounted in the model for almost around 20% is the movement of safe haven currencies. And so ultimately, I think if there is a devaluation of the dollar and the dollar will keep devaluing, then it is an environment that supports the movement of gold upwards. And I think it's somewhat different from what we saw in 2008, in that there was not as an aggressive devaluation of the US dollar. There was still a devaluation of the US dollar. It simply was not as aggressive. So, gold made an initial jump upon expectations that the currency will devalue. But in essence, because the US did it so slowly and other countries caught up, when you look at how the prices move for different currencies in the US dollar index, you realize that no, there is no actual devaluation, or there's no visible devaluation, and then investors pulled out, and then we saw this sort of a slump in the gold market. What we're seeing right now is something a little bit different, is that we are actually seeing the dollar devalue before every single other currency, and the US Treasury is going after Switzerland and Vietnam to prevent them from devaluing their currencies. They've listed them as currency manipulators, and a few other countries are on the list too. So you're like, yeah, maybe they're really aggressively trying to devalue the dollar, and that will be good for gold. In a sense, to a certain extent, there is diminishing returns. So it can't go on forever. There's a point when, I'm seeing this was a Swiss franc that, for every single percentage that the gold moves up against the dollar, the Swiss franc moves up about 1/3 of that. So that's another thing to consider. So in the end, what do I think is, is going to happen to gold. I think that gold will probably move back to its normal trading. There's a lot of things going for it. Long-term expectations above 2,000. That's my expectations. Don't take this information and trade on it. I'm not a financial advisor. I'm some dude in his garage making machine learning models and posting them online to say like, look, this is what when I use gradient boosting, I get as results for stock predictions and also for gold predictions. Do I think the stock market will crash? I think it's possible, right? This is not financial advice. This isn't. I don't want to cause I'm not here to cause a panic. I'm just looking at what the machine model prediction is doing, and I'm looking at what the predicted results are. It says that it is possible, but in the midterm, at least the 14-day and the 21-day and the 112-day, it doesn't see that. Now, does it mean that we won't see a stock market crash? No, that's not what I'm saying. I'm saying that it's possible that there might be movement, more volatile movement in the stock market. Now, if this part, right, it goes way down, like it breaks a lot of these volatility bands, this historical volatility bands, then I would say, yeah, it's likely. But if it doesn't, then no, it's unlikely. And if it sticks within the predicted values, then it means that the market is behaving more or less normally based upon past experiences. Now, if there's an external shock, it cannot see what the external shock does. It can't see policy changes. It cannot see, a lot of things. But if the market is behaving normally, then it will treat this as normal. So yeah, I'm not here to say like there's a crash. There could be a crash. I see in the short term there's more volatility. If people do panic and it picks up momentum and it becomes a more long-term thing, we see it more as a weekly thing, and then it converts into a monthly thing, and then we see it into like a quarterly thing, then yeah, then we'll see a downturn in the stock market. But if it doesn't convert into a more long-term view, like at least a 3-month view, I don't think the market will see such a strong downturn. It might see a slight correction, but yeah, it's very hard to say whether it's going to crash or not. I do think that markets are very expensive right now. Doesn't mean that it will crash. Something that can be expensive for a long time. But yeah, it's very hard to say because there's so much money printing going on that, and there's such a devaluation in the real economy of how much money is being spent. And if I look at how much money is being pumped into the economy and how much people are actually spending the money, it's halved. That's not normal either. So either they're all going into assets, and the question is, when will it come out of assets? The answer is, it's very hard to know. People need things to spend on. They need to decide that like spending on real life things is better than putting into financial assets, safe haven assets, gold and silver, real estate. It's difficult to see. Anyways, thank you for watching. If you want to stay up to date on how the predictors work and my gold stacking progression and silver stacking, I haven't ordered silver this Christmas. I was going to, but then I was like, I already bought like quite a lot of gold, and I already have quite a bit of silver, so I'm like, yeah, I'm holding a bit off the silver because it is so volatile. And when I look at how silver moves, it's like, I think there's money to be made if you're day trading silver, but there isn't so much money to be made if you're long-term silver compared to gold. I think a lot of us, we buy silver because it's much cheaper and affordable than gold. And that's the truth, and also we don't want to, also fractional gold tends to have this super high premium, and the only reason why I'm able to get into gold is because I'm not buying modern gold coins. I'm buying sort of fractional gold, investment grade gold that's historical gold, like gold sovereigns from the early 1900s, 1800s, Swiss 20 franc coins. I know that in North America and Canada, these are not considered as investment gold, but for the rest of the world, everywhere else, these coins are codified in law in many places as investment grade gold, especially in the United Kingdom. In Europe, there is a EU, I believe there's a European Union bill that classifies the 20 French franc, the 20 Swiss franc, and the gold sovereign as investment gold, and therefore there is no tax on them. So yeah, that's something to think about. Anyways, thank you very much for watching. This is Dave. Dave out. Oh, click the like and subscribe button. Thanks. Dave out.